Hey everyone. So this is the first installment in Options 101, the PowerPoint series. Here I'm just going to give a quick background on options and how they're used and why they're traded. In order to really understand options, you're gonna have to know these few things, and after you watch this video, you'll have a little bit more of an understanding about what they are and how they're used. So, what are options, guys? Options are simply they're a financial contract that can be used as an insurance on positions in stocks you already own. If you have a lot of stocks, you can use options as an extra income from your stock positions. And my favorite way, and the way that I'll be teaching you guys how to use, the way that I use them, is a way to bet on the market's movements. Um, basically, a lot of people use options as insurance and as extra income, but we're just going to be using options, or the way I use them is just to bet on the market's movements. Bet whether it's going to go up or down and make a lot of money if I'm right. So, first and foremost, options are a financial contract. And when you get this contract, it's not a physical contract like this. I made this up. I thought it looked nice, and it was a good way to explain options. So when you get an option, you're gonna have a strike price, an expiration, a bid and an ask, and a stop quote. So it's going to be for a certain stock. There's going to be a bid and an ask, where the ask is what you'd have to pay if you wanted one right this second, and the bid is what you'd get if you sold it right this second. So if you wanted to buy this contract, you'd have to pay $185 for it times 100 shares. So it'd be $185 for this one contract on CGC, Canopy Growth Corporation. So the owner of this contract has the right to buy 100 shares of Canopy Growth Corporation at a price of $70 per share. So no matter what happens to the price of Canopy Growth Corporation, CGC, no matter what happens to this stock, whether it goes to 100 or 150 or 20, you have the right to buy it at $70 per share. So if you're buying this, then you're buying it in anticipation that you think it's going to be worth more than 70 per share, or just the fact that this financial contract is going to be worth more in the near future. So on October 19th, 2018, if Canopy Growth Corporation stock price does not close over 70 a share and you did not sell it before then, this contract's going to expire worthless. So that's just what an option is. It's a financial contract. And one thing they're used for, puts, is as an insurance policy, which gives you the right to sell a stock at a certain price. So basically, right now, the price of Apple is $220 a share. And the chart's looking kind of treacherous. It's looking like it could come down a little more, maybe even to 216. Who knows? I'm pretty bullish on Apple still, but that's not the point. So maybe somebody's scared and thinks that Apple's going to dive some more. So as an insurance policy, they could buy a Apple put at a strike of 220 until September 14th, 2018. So what that would do is that would give them the right to sell this stock, their 100 shares, at 220, no matter what. So even if it comes down to 210, 215, it doesn't matter. He's getting 220 per share. So even if the 100 stocks you own, the price plummets to 180 a share, you can still sell them this week for 220 a share. It's awesome. So it's like an insurance policy on what stocks you own, and um, you can buy them at all different dates. And the longer further out you go, the more the insurance policy is. So this is one way that people use options, and one of the reasons they're traded. So another reason, or another way people trade options, is they use them for extra income. Now, these people that have the insurance policy and extra income are people who own the stocks. Like, let's say they have 1,000 shares of Apple, so they're able to, they're either able to buy the puts as insurance on the stocks they already own, or they can sell calls. So basically, if John owns 100 shares of Apple, and the price right now is $221.30 a share. So John doesn't think that Apple will go above 240 by next week. So to make money off that, he's going to sell the right to his 100 shares. He's going to sell a financial contract that says that anybody who buys this contract has the right to his shares if they reach 240 a share. So he sells the call and he earns $35. Now, if Apple's stock price closes under 240 on September 21st, he ultimately wins. He keeps his shares and he keeps that premium he collected. However, if the Apple stock price goes to like 250, then he still has to sell his shares for 240 a share. So he just missed out on $10 per share times 100 shares. So he just missed out on $1,000 to gain 35. So, I mean, options can be great, and it seems like free money, but when it goes against you, it's pretty bad. It's pretty gruesome. So that's one way that you can make extra income with options, and that's one of the ways that they're traded, as extra income and as insurance policies. But now the way that I like to use them, and the way that I'm going to be teaching how to use them for the most part, is betting, you'd call it. Because what you're doing when you buy options on a stock is you're kind of making bets, especially if you're going out of the money, meaning betting that it's going to go even higher than the price is now. So like Apple stock price right now is about 220. So this bet, I would call it, is saying that it's going to go up to 240 by October 19th, or it's going to go higher and make this call more expensive, which is going to make you more money. So when you're betting on the stock movement, if you're wrong and the stock moves sideways, you don't keep the same amount of money. You actually lose money. So since there's a time value incorporated in here, and the reason they're $154 and 158 is mostly due to time, because there's a few weeks left, but it's not at that price. Every day that goes by, the price of these will tick down if Apple goes sideways. And if Apple goes down, the price of these is going to go down substantially. The lower the chance of Apple hitting 240, the lower that this financial contract will be worth. But if Apple does continue its uptrend and it does go to 240 or close to it before October 19th, James could be looking at gains of 300% or more easily. And James is allowed to sell this contract at any time. So if Apple moves up to 235 this week and the bid and the ask are now 350 and 360, he can sell it for 100% profit. And if it's down a bunch, he can get out of it, or he can hold it, hoping that it'll return. The problem with options and the risky thing is that if Apple closes below 240 on October 19th and James hasn't sold his position yet, his position will be worthless. So this is just a quick lowdown on what options are about And if you have any questions that I didn't cover, please feel free to ask in the comments or on my Instagram page. I hope this helped you guys out.